Investing. It's a word that conjures images of Wall Street, bustling traders, and the relentless tick of a stock market ticker. But before you dive into the world of stocks, bonds, and mutual funds, it's crucial to grasp some basic investment terminology. Let's break it down, shall we? First, let's talk about assets. An asset is anything of value that can be owned. Think of it as your financial toolbox. It can be cash, real estate, stocks, or even collectibles. The key here is that assets are what you use to build your wealth. The more valuable assets you have, the more financial security you can create for yourself. But remember, not all assets are created equal. Some appreciate over time, like real estate or stocks, while others depreciate, like cars or electronics. Now let's move on to equity. When you hear the term equity, think ownership. If you own shares in a company, you have equity in that company. It's your stake in the business. Equity can also refer to the value of an ownership interest in property, such as your home. If your house is worth $300,000 and you owe $200,000 on your mortgage, your equity is $100,000. It's the difference between what you own and what you owe. Next up is the concept of diversification. This is a strategy that involves spreading your investments across various asset classes to reduce risk. Imagine you're at a buffet. You wouldn't fill your plate with just one dish, right? You'd want a little bit of everything to ensure you enjoy a balanced meal. The same goes for investing. By diversifying, you protect yourself from the volatility of any single investment. If one asset class takes a hit, others may perform well, balancing out your overall portfolio. Speaking of portfolios, let's define that. A portfolio is a collection of financial investments like stocks, bonds, commodities, and cash. Think of it as your personal investment garden. You plant different seeds. Some may bloom beautifully while others might wither. The goal is to cultivate a diverse garden that yields a fruitful harvest over time. Now, let's touch on risk tolerance. This is a crucial concept that refers to how much risk you're willing to take on in your investments. Are you a thrill seeker, ready to jump into high-risk stocks that could either skyrocket or plummet? Or are you more conservative, preferring the stability of bonds and blue-chip stocks? Understanding your risk tolerance is essential because it shapes your investment strategy. If you're too aggressive and can't handle the stress of market fluctuations, you might find yourself in a world of anxiety. Conversely, if you're too conservative, you might miss out on significant growth opportunities. Then there's the term bull market and bear market. A bull market is characterized by rising prices and investor optimism. It's when the market is thriving and everyone seems to be making money. On the flip side, a bear market is marked by falling prices and widespread pessimism. It's the time when investors are cautious and the mood is generally gloomy. Understanding these terms helps you navigate the emotional landscape of investing. Let's not forget about dividends. Dividends are payments made by a corporation to its shareholders, usually in the form of cash or additional shares. It's like a thank you note from the company for being a part of its journey. Not all stocks pay dividends, but those that do can provide a steady income stream, making them particularly appealing for income-focused investors. Now let's discuss mutual funds. A mutual fund pools money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. It's like joining a club where everyone chips in to buy a variety of investments. This can be a great way for beginners to get started, as it provides instant diversification without the need to pick individual stocks. However, keep an eye on fees, as they can eat into your returns over time. Another term you'll encounter is asset allocation. This refers to how you distribute your investments among different asset classes, such as stocks, bonds, and cash. The right asset allocation depends on your financial goals, risk tolerance, and investment timeline. It's like crafting a recipe. The right balance of ingredients can lead to a delicious outcome, while the wrong mix can leave a bad taste in your mouth. Let's also talk about capital gains. This is the profit you make when you sell an asset for more than you paid for it. If you buy a stock for $50 and sell it for $70, your capital gain is $20. However, be aware of capital gains taxes, which can eat into your profits. The tax implications can vary depending on how long you hold the asset, so it's essential to understand the difference between short-term and long-term capital gains. And what about bonds? Bonds are essentially loans you give to governments or corporations in exchange for periodic interest payments and the return of the bond's face value when it matures. They're often seen as safer investments compared to stocks, making them a popular choice for those looking to preserve capital. However, they typically offer lower returns than stocks, so it's essential to strike the right balance in your portfolio. Finally, let's touch on the importance of research and due diligence. Before making any investment, it's crucial to do your homework. Understand the company, the market, and the economic factors at play. Knowledge is power in the investment world. The more informed you are, the better decisions you can make. So there you have it, a crash course in basic investment terminology. It's a vast and complex world, but with a solid understanding of these foundational concepts, you'll be better equipped to navigate the financial landscape. Remember, investing is not just about making money. It's about building a future, creating opportunities, and securing your financial well-being. So take your time, educate yourself, and step into the world of investing with confidence.